Welcome everyone to Brick by Brick. My name is Cynthia Asen. I'm a dealing representative with Parvis Investments. The goal of the Brick by Brick webinar is to make real estate investing feel approachable and easy to understand. It walks us through step by step what the companies that we're offering do. It helps you understand how the private real estate investing works, what to look for, what opportunities, how to think about risk and return. And it's really about building your knowledge over time so you can feel more confident making decisions and growing your portfolio with clarity and purpose. This presentation is for informational purposes only, is based on certain assumptions that may change. It does not constitute investment, legal or tax, accounting advice, nor is it a solicitation to buy or sell any securities. Any forward-looking statements reflect current expectations and assumptions and are subject to risks and uncertainties. Actual results may differ due to market conditions, economic factors, and other variables beyond our control. Please refer to the offering documents before investing. Parvis is an exempt market dealer focused on democratizing access to private markets. The platform really enables you to diversify beyond public markets by offering vetted private real estate, alternative private equity opportunities, supported by independent due diligence and transparent reporting. A little bit more about me. I have over 25 years experience. I specialize in helping individuals, businesses, and small institutions incorporate private real estate investment into their portfolios. Really, I work closely with investors to identify and evaluate and access these curated private market opportunities to guide you through the investment process, ensuring alignment with your financial goals, while leveraging Parvis's rigorous due diligence on these institutional quality offerings. Today, we're going to showcase Pier. It's a real estate company that invests in multifamily apartments in Canada. Their mission is to ensure consistent returns for investors while providing the best living experience for their residents. Over the past several years, they've consistently returned double-digit returns to the investors. Without further ado, please allow me to introduce Randall Warrington with Pier. Thanks, Randall.
Thank you, Cynthia. I'm just going to share my screen if I can figure this out. I think you guys stop sharing your screen, Cynthia, if you can. Okay, great. Thank you again, Cynthia, for the opportunity to chat with yourself and all of your investors. Yeah.
Sorry, it's going to cut you off. Could you move this Google Meet tab here? Hold it from the top, slide it to out of your screen.
Oh, that's got to be out. Sorry.
No, all good. And then for your main screen, make it full screen so we can.
Yeah. Sorry, give me 2 seconds. I'll make it presentation mode. Why is it not going in presentation mode?
I'm thinking that's the biggest it's gonna get. That's okay. That looks good too, as long as it's hiding the Google Meet slide.
Yeah, normally I have the tab down here to go in full presentation mode, and that's all you would see. But I don't know where it is in Google Meet. So this is weird.
Oh, because this isn't Google. This isn't Google Meet.
But this still should go into presentation mode.
It's okay. The original screen was fine.
Okay.
It's okay. Yeah. Okay. 1, 2, 3. You're back at it.
Okay. Thank you, Cynthia. Appreciate the introduction and appreciate the opportunity to share some insights into Pier and our private REIT that we have available to Canadian investors. A little bit of background before I do get started. I've been with Pier now for about 6 months. I've been in the industry for, similar to Cynthia, about 25 years now, all on the investment and sales side, working with both dealer reps and CRO advisors in that channel. So we're excited about the opportunity that we see right now within the REIT space, the private REIT space in Canada. We think there's an exceptional opportunity, especially in the markets and the sectors that we at Pier tend to focus on, and I'll get into some of that in the slide deck. One thing I will mention is that The Pier 4 started in around 2020. The caveat to that is that Adam and Michael and their father, Daryl, who are the founders of the company, they've actually been operators and owners of real estate since the 80s, in 1980s. So their pedigree goes well beyond and well before Pier 4 started. And that's sort of an important caveat as I get into some of the metrics as to how we differentiate ourselves and sort of our expertise that lends to us being able to put up double-digit returns. That's going to come into play as well, as you see. I'll skim through some of this. We'll go through some of it in detail. Obviously, if there are questions from Cynthia or Sarah as we go, we'll address those. But the market environment is obviously fairly important right now, given everything that's going on in the private space, both in the mortgage investment funds, private equity, private debt, and as well as the private real estate space. What we're really seeing right now within that sector, there's a lot of concern. There's a lot of liquidity concerns going on with some of our competitors, and what you're seeing in some of the news and the headlines. We are not caught up in that. I will address sort of why we're not caught up in that. The one thing I would say as a caveat to the end investors and to those watching this is not all gatings are a negative circumstance. So there is a reason why some firms gate, and essentially what gating means is you're limited to a certain amount of redemptions or you're not limited to redeem at all at that time. So there are periods where, especially in the private real estate space, where funds will gate to mitigate the impact to investors on the long term. Simply put, that just means there is some kind of market cycle going on outside of real estate that is driving a liquidity crunch. And so obviously when you look at real estate and the investments underlying your private REITs, those are long-term investments. They are not designed to be traded like a stock or an ETF or on the market on a daily basis. Those are meant to be held for a long period of time to see the return of that underlying asset. When you get gating happening, which we're having right now within the market, in the Canadian market in particular, some of that to us is attributable to some management decisions within those firms, but ultimately decided by what the business lines are for those companies that are gated. One of the differentiating factors that we'll get to as well for Pier 4 is we do not have any development side to our portfolio. We do not have an expertise in that space. We don't know that space. We do not want to get into that space. Development is extremely capital intensive and extremely influenced by obviously interest rates and market sentiment as you go forward from a rent demand side, as well as selling those units to end investors. So we are not in those spaces. What you will see if you look into some of the firms that have gated, all, if not most, all have a development side to their portfolio. And that to us is a big impact of why they're gated and why they have a liquidity issue. That being said, I'll jump in a bit here. The genesis of Pier 4 and where we look to invest our capital and our investors' capital, the number one fundamental driver of our business is the national vacancy rate. We don't see this significantly getting any better in the short term and the long term. Typically what you had in 2024, the national vacancy rate was 2.2%. In 2025, it stayed around 3.1%. This is the driver of what we do and why we do what we do. So this will always come into play. Keep this in mind as we go through some of the other slides going forward. Supply and demand. I'm sure you've heard Cynthia talk about it in other sort of brick by brick podcasts and in some of your conversations with colleagues and friends. Supply and demand is the genesis of we're not having enough housing built and our population is still growing with immigration. Yes, immigration numbers did come down in 2025, but to be honest, they came down to 380,000 immigrants in 2025 as opposed to the 500,000 in the previous years. So coming down is a relative term. There is still a significant pent-up demand for housing. Housing starts continue to lag behind demand. We need to build approximately 3.1 million new units need to be built by 2030 in order to close that gap, and we don't see that happening anytime soon. Current pace, we will come nowhere near closing that gap. Our target asset class. So Pier 4 differentiates ourselves in a couple different ways. Predominantly, one of the main ways is we look for, I won't say older buildings, we look for properties that were built sort of between 1960 and 2000. We're not looking for the glass towers. We're not looking in the downtown urban cores. We are looking in secondary markets with high growth potential, with stable population growth that are accessible to urban core centers. And so when we think about that, I think of sort of Kitchener-Waterloo, Moncton, New Brunswick, Dartmouth outside of Halifax, Peterborough in sort of Eastern Ontario. So those kinds of markets are where we typically focus on. And what we're seeing there is the preference for more affordable, larger units with mature asset classes that we can then purchase those buildings over time, as you'll see some examples, do some suite turnovers, do some renovations, do some enhancements to the portfolio as far as LED lighting, security cameras, enhancements to low flow toilets, et cetera, and that increases our NOI on the actual property. So those are the typical markets we'll focus on. Why do we do that? As you can see from here, the average rental growth, the most growth is coming in those secondary markets. It's coming in markets that we tend to focus on. So again, New Brunswick, key driver, Nova Scotia, key driver. We are not in Quebec as yet. We do not in our pipeline currently have any properties that we're looking at in Quebec, but that's not to say we won't at some point. Alberta, we are not in right now. It is much too cyclical as well, and sort of too many ups and downs right now to look into that market for an opportunistic purchase point. But the Atlantic immigration program that has been in place and continues to be in place is a key driver to immigration numbers moving out east. That in turn drives rental growth. That in turn drives property value appreciation, which in turn drives return on the NAV for inbound investors in Pier 4. Specific cities that we're looking at. So again, this is fundamental to why we are in the cities we are in. Halifax, Moncton, St. Catharines, which includes Welland, London, Kitchener-Waterloo, Hamilton, Guelph. Those are our core main areas we look at within Ontario. We're starting to look into Peterborough going east now with the GO train going into Peterborough, as well as the 407 going out that way. There are quite a few now commuters that live in Peterborough that come into sort of the north end of Toronto or the east end of Toronto for their daily commute. These markets will continue to drive our growth. They will continue to drive rental growth. So as we get suite turnovers and we can complete the renovations we have targeted for those buildings, that again will in turn close the gap to market for those properties. So one of the terms we talk about a lot and we think is very important in the private REIT space, especially in Canada, is gap to market. There is a correlation between interest rates and cap rates. One that I think most end investors typically are not sort of fully following. A cap rate is essentially the measure of a property's expected return based on what the NOI is relative to the purchase price. So essentially, as you can grow your NOI, your cap rate is going to increase there and it's going to generate returns for you on the long term as an investor. What we typically want to do is stabilize the return profile we can. As you see interest rates come down, cap rates typically come down as well. And that usually means there's a compression in the valuation of the properties. That does not mean we're not going to generate returns. That just means we have more work to do on the NOI side, more work to do as far as increasing rents, closing that gap to market, and being able to generate returns to the NAV, which ultimately then is returns to the end investor. When we look at the overall fund, this is a snapshot as of end of Q4 of last year, what our overall portfolio is. So 4.5% is our weighted average cap rate for the properties on a whole. We have 41 properties that are under ownership or under contract for ownership. We have one property closing actually Monday of next week, which is included in that 41. 2,041 units. Our occupancy rate is just under 97%. We have an 8% distribution on a monthly basis, paid out as return of capital, so much more tax efficient than just a distribution or a dividend distribution. Current NAV is 11.35. Targeted return between 12 and 15%. And again, so what we have on the internal property management, we have a vertical integration within Pier 4. Again, this is one of the unique features that we have versus our competitors. So Pier 4, we have the ownership of the asset. We have the finance team that funds it. We have the property management side that is employed by Pier 4, so they're not third party that we contract out to. All our property maintenance and renovation crews are Pier 4 employees. We have offices in 4 cities now: London, Cambridge, Toronto, and Moncton. And the office in Moncton opened late last year with the notion and emphasis that we have a significant number of properties out there now. We need to have an office out there that can manage those properties on a day-to-day basis. Just a quick snapshot from our history. We started in 2020, right in the middle of COVID. Michael and Daryl Ashby and Adam Ashby, the 3 Ashbys. Daryl is the father. Michael and Adam are the CEO and CFO. They started it in 2020 officially, and this has grown, as you can see, from an asset level now at 425 million and 41 properties, as I just mentioned. Investment growth since inception, again, since 2020, total inception return 59% on the A class. Obviously, if we're looking at other classes that are available, the return profile will be different, but we use A class. The DRIP program that we have, that is a unique feature, I believe, of most private REITs in Canada. If you reinvest your distributions, you will be buying units at a 2% discount on the NAV. So you'll actually be getting a 2% discount on the purchase price. And then those units, of course, compound and generate further returns down the road for you. So that's a great opportunity. If you don't need the income stream currently, then I would suggest obviously looking at the DRIP program and enrolling in that. Sharp ratio. This again is a risk return metric that the finance world like to use. Obviously, the higher the better. For us, it is more about the stability and the downside protection of what we offer, as opposed to just the outright, return profile of what we can put forward. We have obviously a very high Sharp ratio. We are extremely low correlations to overall markets, i.e. TSX, NASDAQ, S&P 500, but more so even lower correlations to the S&P ETFs, mutual funds, any sort of asset class you're looking. We are a great fit, a great complement to an overall portfolio that will also lower your downside risk, but at the same point, not sacrifice your returns in the long run either. Further that, our high watermark and low watermarks, we have never had a negative year, knock on wood. We don't see that happening. We're anticipating a positive sort of next couple of quarters again with the properties that we've closed on this year. Again, this just shows the variance of our returns compared to some other ETFs and other indexes that are out there right now. We are slow and steady. We are consistent. We are low correlation to your traditional asset classes that are in portfolios, and we provide a return that is stable and income generating for those investors that want a distribution on a monthly basis. So you've heard these names mentioned. Daryl's the father. He's our chairman and co-founder. Adam and Michael run the day-to-day operations in the office here. I've touched on the other points at the bottom there. Their expertise, I will tell you this, I have heard firsthand stories from some of our property and maintenance guys that we've met out in Cambridge. They can tell stories of when Adam and Michael were 14, 15, 16 years old, and they were working in Daryl's building that he had at that time, stripping paint off the walls, installing doors, changing windows, ripping carpet up. These guys came from the grassroots side of this business. They did not come from the Bay Street angle of they worked on a trading desk and understood the real estate market from that side. They learned the real estate side from the contractor aspect, learned how to process orient that mandate, and have now multiplied that across the Pier 4 REIT, and that's what they've offered to clients now. So from a renovation, cost management, understanding what each unit should cost on a cost per door basis, these guys have it down to a T, and that's one of our very strong differentiating factors that we have versus some of our competitors out there. Independent board, independent trustees and directors. I won't go through each name. The bios are there. You can read those, but that just keeps us honest. That keeps an independent point of view. Everything we do from a firm level has to be approved as far as cost and spends by this independent directors and trustees. So very quickly on our strategy, what we typically focus on and the driving force when we look at a portfolio acquisition is the 3 R's. We want to realize, revitalize, and return to our investors. And what does that mean from their standpoint? From an adding value standpoint, we want to maximize investor results in everything we do. So when we look at a new property, once we've decided we're going to purchase it and it closes, we will evaluate that property based on what the market metrics tell us as far as we think the average rents are in that space and what we can get for that rent in those units in that building. What that will then dictate is which level of renovations do we target for that building. So each building is given a bronze, gold, or platinum tag per se, and that dictates what level of renovations we think each unit should get, ultimately dictating what we think our rent growth can be within that space. So a lot of factors go into what renovation tag a building will get. Obviously, population growth, proximity to transit, proximity to universities or downtown cores, etc. That will dictate what we think we can drive rent to. So typically right now, majority of our renovations in our buildings are in the gold category. That's about 70%. What that means from a renovation standpoint is we do the cosmetics, we do paints, curtains, doors, all that kind of stuff, but then you're starting to get stainless steel appliances. We're updating the cabinets in the kitchen. We may not be changing the layout of the unit, but everything in the unit is going to be upgraded to modern standards. Platinum is about 25% of our renovations right now, and that is a full take it down to the studs, look at layout, what's the most efficient use of the overall square footage of that unit. You know, is it a 1 plus a den, or can we turn it into 2 bedrooms? What space do we have? And that is a complete gut job, rebuild it, and then re-rent it out at a higher rent cost. So every single renovation we do is planned out based on building location, market location, and what we think we can squeeze out of the rent going forward from a market standpoint. Quick examples, there's 2 here. I'll go through one right now. So this is a unit that is in building that's in Kitchener, purchased originally in 2023. We have 16 units. I believe it's now up to 18 units as of this month out of 46 that have been turned over. Before renovations, our pre-average rent was $920. Post-average rent is $1,300. Our gap to market still within the building as a whole is still 27.5%, so extremely healthy gap to market there. What we are seeing is the opportunity to continue as renters leave those units. We will turn those over, do the renovations, and then rent out at market rents. We do not renovate. We do not kick tenants out. We do not force them out just so we can get a renovation done. The other sort of side bonus, I guess, for us in the markets that we're in the secondary markets that we focus on, typically because housing is cheaper in those markets, they're not in the downtown GTA core. Because housing is cheaper in those markets, people are able to save more when they're renting. So we do get a natural turnover in our portfolio of roughly around 20 to 25% on a year-over-year basis on all our buildings. What that allows us to do is to maximize our opportunity for renovations, which then maximizes our profit, which then we can maximize, obviously, the return back to investors through the NAV of the REIT. So it's not a negative when we have tenants leaving. It gives us an opportunity. Our renovation time right now, we have it down to 32 days to get a complete renovation done in a unit. So again, because of that vertical integration I talked about, because of Adam and Michael's background and their knowledge in the renovation space, it is literally down to a science. So the day that unit becomes vacant, the teams are already in there. Whether some demo has to be done, whether some appliances have to come out, that's done the day of, and then they start getting busy on the renovations that are going to be done, and we turn that suite back over and get it rented as fast as we can. Skip down. Prime example for here, if you have any interest, you can take your phone, scan the QR code. This will take you through an actual case study. Again, for a unit in Kitchener, we purchased this property, successfully converted basically previously unused storage lockers. So they were on the main level. They weren't below ground. They were in a high demand area. And we were able to turn those storage lockers, which weren't being used, into studio units that we could rent out. So again, just another niche where we're able to add some extra value based on the experience and understanding the cost of what it would take to turn an empty space into an actual unit, put in plumbing, put in pipes, put in the studio units, what that would cost from a dollar standpoint and what we could get from a return generation standpoint there. So this is one case study. The second one, again, is in Kitchener, another building on Breckenridge Drive. Again, converted a open area into a junior 1-bedroom unit, optimizing functionality and livability, and then ability to increase our rent take and our NOI of that property from day one. Again, because of the vertical integration, one of the first things we try to do when we purchase a building, what can we do right away from a building envelope standpoint? So the envelope is the outside of the building, the grounds of the building, the roof. What can we do from that standpoint to decrease our costs and increase our revenue? And so what that comes down to is Energy Star appliances, LED lighting, high efficiency boilers. There are numerous buildings in our portfolio where, if I legitimately can tell you, I don't think the boilers have been changed in 20, 25 years. And so obviously technology has improved, the efficiency of boilers have improved in that time. Putting in a new boiler alone would save us thousands and thousands of dollars a year. Water sense toilets, and then looking at the building envelope, what kind of roofing do we have? What kind of security do we have in the hallways? Upgrading the lighting in the hallways so it's more safe, more welcoming. All of these implications are some of the first things we do when we look at new buildings and when we take over ownership of them. Very quickly, again, some of the recent acquisitions. Again, we're constantly looking at opportunities. We are very fortunate in the sense that because we don't play in the downtown urban markets, i.e. the Torontos, the Vancouvers, the Calgarys, because we're not in the high-rise glass towers, which is where you're seeing a lot of the real estate headlines that are focusing on those spaces as far as the condo markets, etc. We have no issue as far as opportunities to purchase or opportunities to sell any of our buildings. It's not exaggeration when I say daily, if not weekly, we field calls from investors or other property asset managers looking to purchase one or some or all of our portfolios in certain regions. We have not sold any as yet. We still see tremendous upside in the properties that we do hold. Not to say we won't sell some, but it is a very liquid secondary market as compared to again, some of those core downtown focused property managers. They are the ones, and there's where you're having the liquidity crunch as far as being able to liquidate buildings. So these are some recent ones. They've closed in Q4 of last year. What we have right now, the London property here on the left, that just closed in Q1. That was our largest purchase to date. That was the biggest acquisition that Pier 4 has ever done in our history. It seems like a big price tag. But I will say this, there's 9 buildings on that property. It's 22 acres. So if we cut it down from a average cost per building, it's right inside our wheelhouse. It's about $10 to $15 million a building. The upside is tremendous. That little small building you can see at the front there that looks like sort of a sixplex. That building was completely empty when we took over ownership of this property. We already have the contractors in there turning those units over, and those will be rented out by the end of the month. So that one just closed. Kitchener's closing next week, as I mentioned. Peterborough closes again in Q2, a little bit later in Q2. So our pipeline is robust. We have opportunities. There are lots of these older style walk-up buildings, don't have elevators, no underground parking. You're not looking at pools and gymnasiums in the units or in the buildings. This is the opportunities we're looking for, and this is why, for us, it's a great outlook going forward for us. There's plenty of opportunity for us to look for more buildings in the niche markets that we want to play in. Quick summary, still 41 properties, 13 communities, 3 provinces. This will continue to grow. These cities on the left that you see here in Ontario, I believe there might be one new one getting added in Q2, further down in Q2 that wasn't on that previous slide. Moncton and Halifax tend to be the focal area right now on the East Coast. Not to say we don't go anywhere else, but there's a big immigration sort of government policy that's pushing population out there. Moncton is in high demand, and so we're seeing lots of great opportunities there as well. Again, some summary snapshots for you from where we started in 2020 to where we are now. 2020, they started with 73 units. That was the first foray they had into it. It was obviously very small right during COVID. When I tell you the first office they had in the photos I've seen of the very first office, it was probably the 3 of them sitting in about 150 square feet facing each other and just, looking at buildings and trying to acquire them and turn that over. So they've grown tremendously. We're at a great spot now where our aim is to get to sort of 3,500 units by the end of the year. With the acquisition we have in the pipeline right now, we'll probably be around 25 to 2,700 units, I would think, by the end of Q2, if not early Q3. And then we'll get into Q4 at that point and sort of close that out for the year. Currently at 425 million in assets. I do believe that will, you'll see a jump of that at the end of Q2 once those properties have closed, and the London property obviously is priced into the portfolio as well, because that does not include the London property. Portfolio gap to market as a whole, we have a 50% plus gap to market. Again, the benefit of this is there is tremendous upside for us still in our existing portfolio of units. If interest rates go up or down, it will not have an impact on our ability to generate profit. We have enough wiggle room. We have enough space that if rent contraction was to take hold and we were unable to increase our rents to where we think they are from the market standpoint, we still have plenty of upside where from what we're starting at to where we could still increase rents, we would still see positive returns for the end investors. So that's a very big number that I think if you compare that to what's available in the Canadian REIT, private REIT space, this is the best gap to market you're going to find out there right now. And again, that just speaks to the markets we're in, the types of buildings we're buying. Units by province, AUM by province, that's a breakdown on the right-hand side there. And then offering details from Parva's standpoint, you have Class A, Class C, and Class D. So Class A is more of an upfront purchase option. I will say this, when we look at purchasing options that fit for you as the investor, look at what your redemption schedule is from the opportunity to redeem and when you can redeem. That's really what dictates a lot of these options. We have a 3-year sort of lockup per se. Again, because our underlying asset is real estate and physical real estate, it's not meant to be an ETF. It's not meant to be traded on a weekly, monthly, or even yearly basis. This is a long-term allocation that hopefully is in your portfolio for the long term, will generate some returns and distributions for you and provide some downside stability against your other portfolio holdings. So I will leave it at that. This is where I think hopefully you sit down with Cynthia and align yourselves with what works for you from an investor standpoint, and that's the options available from Parva's standpoint.
Thank you, Randall. That was very informative. I think it was well laid out and very clear on what Pier 4 does, who they are, and why they're successful. So just have a couple questions that I'd just like to maybe clarify. Market rent gap is really important. And obviously at 50%, 50+%, you've got some room, but what is the sensitivity to interest rates and cap rates? Does Pier 4, when they do their underwriting, do that model to show, well, if interest rates stay where they're at, if they jump a couple points, etc.? There must be, I think it's more about the underwriting, like how do you find these buildings and how do you stabilize them quickly to be able to sustain distributions? Because I think that's really important for a lot of investors today.
Yeah, great question. I'll answer the first part, how we find these buildings. So because we are in, I don't want to say the smaller niche markets, i.e. the secondary markets and the types of buildings we're trying to buy, we're not buying the newer, we're trying to buy older buildings, to be blunt. We have a very good reputation of being able to close on buildings that we're interested in. 95% of our financing is CMHC insured and it's CMHC financing. So we have, call it commercial brokers that literally will call us on a daily basis and say, would you look at this property? Would you look at that property? I've heard this one's coming up. So our London property that we just closed on, that was an off-market deal. That didn't even hit the market. So we had a call from the previous owner through their broker. Would we look at this? Obviously, there was some back and forth as far as what offering price would be. And that's what they settled on. And from the day we closed on it, it was appraised at $13 million above what we paid for it. So we get calls on the daily because our niche now is out there, especially in the markets we're already in, i.e. London, Hamilton, Guelph, KW. That's a bit of a stronghold for us in Ontario. Now getting into Peterborough quite a bit going forward, and then Moncton and Halifax. We typically got the first call for any sort of smaller type building like this. The other caveat of this is most of these buildings that we're buying, we're not buying off institutional sellers. We're buying off mom and pop owners that have owned it for 30, 40, 50 years. There was 2 buildings in Hamilton we acquired early last year that literally were bought off the 2 gentlemen that built it sort of 60 years ago. And so we have that kind of pedigree now. We have that reputation. If someone's trying to unload this type of a building, they're going to call us, or the broker's going to call us and try to get us involved in that as fast as we can. How we work with the cap rates. So every building we look at, whether we decide to put an offer on it or we just looking at it and doing our due diligence, we are now and have created our own sort of internal, for anyone in Ontario, there's an MLS site that gives you sort of the pricing of all real estate in Ontario. We've created our own database of what every building we look at and what we think the metrics are. So our underwriting team goes through every single building that comes across their desk. Whether we act on it or not, we've now created a database that we have market comparables to our own metrics. And so interest rates and cap rates tend to move in the same direction. So if interest rates start going up, then yes, our cap rates are going to go up. If they come down, obviously cap rates are going to come down, and that's going to compress the cap rate for us. As long as we have that buffer with our gap to market, that allows us to mitigate any risk to the investor on upside or downside moves. The one unit I will talk about, if I can, Cynthia, quickly. This building here, which we skimmed over, Elmwood, is the second property one that we sort of just skipped over. We have turned over, out of those 31 units, I just want to make sure I'm accurate, we have turned over 31 units out of 44. So this is, to me, the prime example of what we want to do with every single building we own. This is what we want to get it to. So the gap to market now is 5%. We have maximized the value we can out of this property. We've done what we're supposed to do. As units became available, we renovated, increased market rent. We went from $761 up to close to $1,300 right now. 50% ROI. This is in Moncton, obviously, as I mentioned. This, to me, is the prototype of what we're trying to do on every single property we own.
Understood. So, I mean, just in my mind, it's your boots on the ground, vertical integration has created a lot of economies. Standardization of what you do in the units, gives you that really streamlined turnover time, which time is money in the real estate world. So, excellent. That's great to know. I didn't know that about Pier 4.
Yeah.
So just on a question of today, everyone's a little uncertain. Everyone always is when they look at private equity, especially if they've been in the public market space. How sustainable is the current distribution?
We've talked about this at length over the last 3 months because of what's going on in the marketplace. There's no risk of that distribution being cut at all. So our typical, we measure, and myself in particular measures the average redemptions that we get in each month versus our inflows each month. We are typically in that 5 to 6.5% redemptions versus our inflows each month. So we are very healthy in that category. The capital we have, again, there's a couple buildings they're looking at, we've had offers on. I don't know for sure if we're going to pull the trigger on selling those or not. We are very prudent as far as we know what the market's doing. We know what the market sentiment is. Let's make sure we're being prudent and having liquidity opportunities. As long as we can continue to see those kinds of return generations from suite turnovers, increasing rents, and having that continue to generate NOI on each property, distribution will be fine. We've never missed a distribution in our 5 years.
There you go. That says it all. We'll leave it on that and just want to recap. Pier 4 is a family-run private real estate investment strategy company focused on acquiring and improving multifamily apartment buildings across Canada, particularly now in Ontario and Eastern Canada. It's really, you're focused on older, underperforming, mismanaged properties, and sounds like succession plans for people that have owned these properties forever. And these markets also have very strong housing fundamentals. You're creating value through renovations, operational improvements, and rent optimization. So I think in my mind, you have 2 core drivers: stable income from rental cash flow and long-term appreciation. Yeah. So I'm, a firm believer that this is a great piece of someone's financial portfolio, sustainable, long-term, and in, realizable and attainable market. So thanks, Randall, for the time. That was great, very insightful, very concise, and we look forward to working with you.
No, thank you guys for the opportunity. Appreciate it.
Have a great day.
Thanks, everyone.
Thanks.